Assalamualaikum warahmatullahi wabarakatuh. I'm Antap Ahmad Nuaini Mangurangka. I'm with Abdullah Muhammad Najir and Hajumar Ana Junaima. We are going to report the auditing and internal control. After studying this chapter, you will know the difference between attest service and advisory services and be able to explain the relationship between the two. Understand the structure of an audit and have a firm grasp of the conceptual elements of the audit process. Understand internal control category presented in the COSO framework. Be familiar with the key feature of Section 302 and 404 of the Sarbanes-Oxley Act. Understand the relationship between general control, application controls, and financial data integrity. My part is to discuss to you the overview of auditing up until the communicating results. The second reporter will discuss the internal objective, principle, and models, and the last part will be discussed by Abdullah Muhammad Najir. Again, I'm Antap Ahmad Nuaini Mangurangka, who believes the bravest heart is the one that stays even when it's in pain. Let's start. The overview of auditing. Let's talk about the overview of auditing. Business organizations undergo different types of audit for different purposes. The most common of this are the external financial audit, internal audit, and fraud audit. Each of these will be briefly discussed by yours truly. Now let's talk about the external financial audit. An external audit is an independent attestation performed by an expert. The auditor who expressed an opinion regarding the presentation of financial statement. This task, known as the attest service, is performed by a certified public accountant who work for public accounting firms that are independent of the client organization being audited. The audit main objective is always associated with assuring the fair presentation of financial statement. These audits are therefore often referred to as a financial audit. The Securities and Exchange Commission, or already known as SEC, requires all publicly traded companies be subject to financial audit annually. CPAs conducting such audit represent the interest of outsider, stockholders, creditors, government agencies, and the general public. The CPA's role is similar in concept to a judge who collects and evaluates evidences and renders an opinion. A key concept in this process is what we call the independence. Public confidence in this stage is in the public confidence in the reliability of the company's internally produced financial statement rests directly on an evaluation of them by an independent auditors. Now let's talk about attest service versus advisory service. Let's differentiate the two. Now firstly, an important distinction needs to be made regarding the external auditors traditionally attestation service and the rapidly growing field of advisory services, which many public accounting firms offer. Now let's define what attest service is. An engagement in which a practitioner is engaged to issue or does issue a written communication that expresses a conclusion about the reliability of a written assertion that is the responsibility of another party. The following requirements apply to attestation services. These are the attestation service requires written assertion and a practitioner written report. Attestation service require the formal establishment of measurement criteria or their description in the presentation, the level of service as well. Now let's define what is advisory service. Advisory service are professional services offered by public accounting firms to improve their clients' organizations' operational efficiency and effectiveness. The domain of advisory services is intentionally unbounded so that it does not inhibit the growth of future service that are currently unforeseen. As example advisory service include actuarial advice, business advice, at saka yung mga fraud investigation services, information system design and implementation, and internal control assessment for compliance with SOX. Actually, it is now unlawful for a registered public accounting firm that is currently providing a test service for a client to provide the services such as bookkeeping or other services related to the accounting records or financial statement of the audit client. Also, the financial information system design and implementation, legal services and expert services unrelated to the audit, and any other services that the board determines by regulation is impossible. Now, the advisory service as well is the units of public accounting firms responsible for providing IT control related clients support have different names in the different firms, but they all engage in tasks known collectively as IT risk management. Now let's talk about the internal audit. Internal auditors perform a wide range of activities on behalf of the organizations, including conducting financial audit, examining on operational compliance with organizational policies, reviewing the organization compliance with legal obligation, evaluating operational efficiency, and detecting and pursuing fraud within the firm. An internal audit is typically conducted by auditors who work for the organizations, but this task may be outsourced to other organizations. Internal auditors are often certified as Certified Internal Auditor or a Certified Information System Auditor or CISA, while internal auditors self-imposed independence to perform their duties effectively. They represent the interests of the organization. This auditor, actually, they generally answer to executive management of the organization or the audit committee of the board of directors of if one exists. Now, let's talk about fraud audit. Ito ay napakakailangan or increase the popularity in recent years as a corporate governance tool. They have been thrust into prominence by a corporate environment in which both employee theft of asset and major financial fraud by management. Ano ba ang objective nito? The objective of a fraud audit is to investigate anomaly and gather evidence of fraud that may lead to criminal convictions. Sometimes fraud audits are initiated by corporate management who suspect employee fraud. Alternatively, board of directors may hire fraud auditors to look into their executives if theft of assets or financial fraud is suspected. Now let's talk about the role of the audit committee. The board of directors of publicly traded company from a subcommittee known as the audit committee, which has special responsibilities regarding audit. This committee usually consists of 3 people who should be outsider, not associated with the family executive management, nor former officer, and etc. With the advent of the Sarbanes-Oxley Act, at least one member of the audit committee must be a financial expert. The Audit Act, the audit committee serve as an independent check and balance for the internal audit function and liaison with external auditors. So one of the most significant changes imposed by SOX has been to the relationship between management and external auditor. Prior to SOX external auditors ay nihahired and pina-fired ng isang management. So many believe with some justification that this relationship erodes auditor independence when dispute over audit practice arise. So the SOX mandate that external auditor now report to the audit committee who hire and fire auditors and resolve dispute. Now, let's talk about the financial audit component, the auditing standard, and the systematic process. The product of the attachment function is a formal written report that expresses an opinion about the reliability of the assertion contained in the financial statement. Now let's talk about the auditing standard. Auditing standards are divided into three classes. These are the General Qualification Standard, Field Work Standards, and Reporting Standard. The GAAS established a framework for prescribing auditor performance, but it's not sufficiently detailed to provide meaningful guidance in specific circumstances. To provide specific guidance, the American Institute of Certified Public Accountant, or the ICPA, issues statements on auditing standard, or SAS, as authoritative interpretation of GAAS. SAS are often referring to as an auditing standard or GAAS, although they're not the 10 generally accepted auditing standard. So statement on auditing standard are regarded as authoritative pronouncement because every member of the profession must follow their recommendation or be able to show why a SAS does not apply in a given situation. The burden of justifying departure from the SAS falls upon the individual auditor. Now let's talk about a systematic process. Conducting an audit is a systematic and illogical process that applies to all forms of information systems. While important in all audit settings, a systematic approach is particularly important in the IT environment. So the lack of physical procedure that can be visually verified and evaluated injects a high degree of complexity into the IT audit. Therefore, a logical framework for conducting an audit in the IT environment is critical to help the auditor identify all important processes and data files. Now we're down to my last part, the management assertion and audit objectives. Also, the obtaining evidence and asserting materiality. The organization's financial statement reflects a set of management assertions about the financial health of the entity. The task of the auditor is to determine whether the financial statements are fairly presented. To accomplish this goal, the auditor establishes audit objectives, designs procedures, and gathers evidence that corroborate or refute management's assertion. This assertion fall into 5 general categories. First is what we call the existence or occurrence assertions. Second is the completeness assertion. Third is the rights and obligation assertion. 4 is the valuation or allocation assertion. And lastly would be the presentation and disclosure assertion. Generally yung auditors ay nagde-develop sila ng audit objectives and design as audit procedures based on the preceding assertion. Let's talk about obtaining evidence. Auditors seek evidential matter that corroborate management assertion. In the IT environment, this process involves gathering evidence relating to the reliability of computer control, as well as the content of database that have been processed by computer program. Evidence is collected by performing tests of control, which establish whether internal controls are functioning properly, and substantive tests, which determine whether accounting database fairly reflect the organization's transactions and accounting balances. And lastly would be the let's talk about asserting materiality. The auditor must determine whether weakness in internal control and misstatement found in transaction and account balance are material in all audit environment. In assessing the materiality is an auditor judgment. So in an IT environment, however, this decision is complicated further by technology and a sophisticated internal control structures. And lastly, let's talk about the communicating results. So the auditor must communicate the result of their test to interested users. So the independent auditor renders a report to the audit committee of the board of directors or stockholders of a company. So the audit reports contains, among other things, an audit, of course, their audit opinion. So this opinion is distributed along with the financial report to interested parties, both internal and external, to the organization. IT auditors often communicate their findings to internal and external auditors, so who can then integrate these findings with the non-IT aspects of the audit. Again, thank you very much for listening.
Assalamualaikum warahmatullahi ta'ala wabarakatuh and good day everyone. So I am Haji Umar Ana Junaina and I will be discussing audit risk. So what is audit risk? Audit risk is the probability that the auditor will render an unqualified clean opinion on financial statements that are, in fact, materially misstated. Audit risk is the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. Material misstatements may be caused by error or irregularities or both. When we say irregularities, in the Philippines, it is fraud. So, errors are unintentional mistakes, while irregularities are intentional misrepresentations associated with the commission of a fraud, such as the misappropriation of physical assets or the deception of financial statement users. So, the auditor's objective is to achieve a level of audit risk that is acceptable to the auditor. So, we have the components of audit risk model: the inherent risk, control risk, and detection risk. Then let's talk about inherent risk. So, inherent risk is the susceptibility of an account balance or class of transaction to misstatement that could be material individually or when aggregated with misstatements in other balances or classes, assuming that there were no related controls. Inherent risk is the susceptibility of an assertion about a class of transaction, account balance, or disclosure to misstatement that could be material before consideration of any related controls. So, for account balance or transaction that are more susceptible to material misstatement, um, inherent risk is assessed at a higher level. So, the higher the assessed inherent risk, the more procedures are performed to detect the expected material misstatements. For account balances or transactions with lower inherent risk, less extensive procedures may be performed. Then let's talk about the control, second component of audit risk model. It is the control risk. Control risk is the possibility that a misstatement that could occur in an account balance or class of transaction that could be material, individually or when aggregated with misstatements in other balances or classes will not be prevented or detected and corrected on a timely basis by the accounting and internal control system. So, control risk is the risk that a misstatement that could occur in an assertion will not be prevented or detected and corrected on a timely basis by the entity's internal controls. So let's have this example. So we have the quantity, we have a 10 units under the quantity and we have the unit price 20 and the total 2000. So assuming the quantity and unit price fields in the record are correctly presented, the total value of 2000 is an error. So an accounting information system or AIS with adequate controls should prevent or detect such an error. However, if controls are lacking and the value of total in each record is not validated before processing, then the risk of undetected errors entering the data files increases. Auditors assess the level of control risk by performing tests of internal controls. So in the example, the auditor could create test transactions including some with incorrect total values which are processed by the application in a test run. The result of the test will indicate that price extension errors are not detected and are being incorrectly posted to the accounts receivable file. And the third component of audit risk model is the detection risk. Detection risk is the risk that the auditor's substantive procedure will not detect a misstatement that exists in an account balance or class of transactions that could be material individually or when aggregated with misstatements in other balances or classes. So, detection risk is the risk that the procedure performed by the auditor to reduce audit risk to an acceptable low level will not detect a misstatement that exists and that could be material. Auditors set an acceptable level of detection risk that influences the level of substantive test that they perform. So we have the formula to get the audit risk. So, audit risk is a product of the risk of material misstatement and detection risk. So, the risk of material misstatement is a function of inherent risk and control risk. So that the audit risk model provides that um, audit risk is equals to inherent risk times control risk times detection risk. Financial auditors use the audit risk components in a model to determine the scope, nature, and timing of substantive tests. So the audit risk model is AR equals inherent risk times control risk times detection risk. So we have this example. Assume that acceptable audit risk is assessed at a value of 5%, consistent with the 95% confidence interval associated with statistics. By illustration, assume inherent risk is assessed at 40% and control risk is assessed at 60%. What would be the level of planned detection risk needed to achieve the acceptable audit risk of 5%? So we have this formula AR equals to IR times CR times VR, where AR is 5%, IR is 40%, CR and 60%. Then we have to find detection risk. So let's substitute. Then we have the detection risk of 20%. Then let's reduce the control risk to 40% and recalculate detection risk. So substitute, then we have a detection risk of 31%. So in order to achieve an acceptable level of audit risk in the first example, auditor must set planned detection risk lower, which is 20%, than in the second example, which is 31%. Because the internal control structure in the first example is more risky, which is 60%, than it is in the second example we have, which is 40%. So to achieve the planned detection of 20% in the first example, the auditor will need to perform more substantive tests than in the second example, where the risk is lower. The relationship between tests of control and substantive tests. Tests of controls and substantive tests are auditing techniques used for reducing audit risk to an acceptable level. The stronger the internal control structure as determined through test of controls, the lower the control risk and the less substantive testing the auditor must do. In contrast, the weaker the internal control structure, the greater the control risk and the more substantive testing the auditor must perform in order to reduce audit risk. So in summary, the more reliable the internal controls, the lower the control risk probability. That leads to a lower detection risk, which will lead to a fewer substantive tests being required. Then let's talk about the IT audit. The public expression of the auditor's opinion is the culmination of a systematic financial audit process that involves three conceptual phases: the audit planning phase, test of control phase, and the substantive testing phase. So, an IT audit focuses on the computer-based aspects of an organization's information system, and modern systems employ significant level of technology. So the first step in the IT audit is audit planning. So before the auditor can determine the nature and extent of task to perform, he or she must gain a thorough understanding of the client's business. A major part of this phase of the audit is the analysis of audit risk. So the auditor's objective is to obtain sufficient information about the firm to plan the other phases of the audit. The risk analysis incorporates an overview of the organization's internal controls. During the review of controls, the auditor attempts to understand the organization policies, practices, and structures. So in this phase, the auditor also identifies the financial significant applications and attempts to understand the controls over the primary transactions. So audit planning helps the auditor to perform the audit in an efficient and effective manner. It also involves establishing the overall audit strategy and developing an audit plan. So, tests of controls. The objective of test of control is to determine whether adequate internal controls are in place and functioning properly. In order to accomplish this, the auditor performs various of tests of controls. So, the evidence gathering technique used in this phase may include both manual techniques and specialized computer audit techniques. So in summary, the auditor must assess the quality of the internal controls by assigning a level for control risk. The third phase of the audit process focuses on financial data. So, substantive test involves a detailed investigation of specific account balances and transactions through. For example, a customer confirmation is a substantive test sometimes used to verify account balances. The auditor selects a sample of accounts receivable balance and traces this back to their source, which is the customers, in order to determine if the amount stated is in fact owned by a bona fide customer. By that, the auditor can verify the accuracy of each account in the sample. So based on such sample findings, the auditor is able to draw conclusions about the fair value of the entire account receivable asset. Some substantive tests are physical, labor-intensive activities such as counting cash, counting inventories in the warehouse, and verifying the existence of stock certificates in a safe. So, in an IT environment, The data needed to perform substantive tests are contained in the data files that often must be extracted using CATs or computer-assisted audit tools and techniques software. So let's talk about the internal control. Organization management is required by law to establish and maintain an adequate system of internal control. Consider the following SEC statement on this matter. The establishment and maintenance of a system of internal control is an important management obligation. A fundamental aspect of management's stewardship responsibility is to provide shareholders with reasonable assurance that the business is adequately controlled. Additionally, management has a responsibility to furnish shareholders and potential investors with reliable financial information on a timely basis. The brief history of internal control legislation. We have the SEC Acts of 1933 and 1934, the Copyright Law 1976, the Foreign Corrupt Practice Act of 1977, the COSO 1992, and the Sarbanes-Oxley Act of 2002. Let's talk about the SEC Acts of 1933 and 1934. Following the stock market crash of 1929 and the worldwide financial fraud by Ivar Kregar, the U.S. legislature passed two acts in order to restore confidence in the capital market. The first was the Securities Act of 1933 and had two main objectives: is to require that investors receive financial and other significant information concerning securities being offered for public sale and prohibit deceit, misrepresentations, and other fraud in the sale of securities. The second was the Securities Exchange Act of 1934, created and Exchange Commission and empowered it with broad authority over all aspects of the securities industry, which included authority regarding auditing standards. So the SEC Acts also required policy traded companies to be audited by an independent auditor. It also required all companies that report to the SEC to maintain a system of internal control that is evaluated as a part of the annual external audit. Then we have the Copyright Law 1976. So this law has multiple revisions, added software and other intellectual properties into the existing copyright protection law. It is of concern to IT auditor because the management is held personally liable for violations. Then we have the FCPA of 1977, or the Foreign Corrupt Practices Act. So it is indicative of extent of corruption in business world and impacted accounting by requiring accurate records and internal controls. So this Foreign Corrupt Practices Act of 1977 requires companies registered with the SEC to do the following: keep records that fairly and reasonably reflect the transaction of the firm and its financial position, and maintain a system of internal control that provides reasonable assurance that the organization's objectives are met. So the Foreign Corrupt Practices Act has a significant impact on organization management. With the knowledge that violation of the Foreign Corrupt Practices Act could lead to a heavy fines and imprisonment, managers have developed a deeper concern for control adequacy. Then COSO in 1992. Following the series of S&L scandals of 1980s, a committee was formed to address this fraud. Originally, the committee took the name of its chair, Tradeway, but eventually the project became known as Committee of Sponsoring Organizations, or COSO. The sponsoring organization included Financial Executive International or FI, the Institute of Management Accountants (EMA), the American Accounting Association, the AECPA, and the IIA. The committee spent several years promulgating a response. It was determined earlier on that the best deterrent to fraud was strong internal controls, so the committee decided to focus on an effective model for internal controls from a management perspective. So the result was the COSO model. Then the ECPA adopted the model into auditing standard and published SAS number 78, which is the consideration of internal control in a financial statement audit. Then we have the Sarbanes-Oxley Act of 2002. It was signed into law on July 30, 2002. So the law support effort to increase public confidence in capital market by seeking to improve corporate governance, internal controls, and audit quality. In particular, Sarbanes-Oxley requires management of public companies to implement an adequate system of internal controls over their financial reporting process. This includes control over transaction processing systems that feed data to the financial reporting systems. Management's responsibilities for these are codified in Section 302 and 404 of Sarbanes-Oxley. So, Section 302 requires corporate management certify their organization's internal controls on a quarterly and annual basis. Specifically, external auditors must perform the following procedure quarterly to identify any material modification in controls that may impact financial reporting. First, interview management regarding any significant changes in the design or operation of internal control that occurred subsequent to the preceding annual audit or prior review of interim financial information. Second, evaluate the implications of misstatement identified by the auditor as part of the interim review that relate to effective internal controls. And lastly, determine whether changes in internal controls are likely to materially affect internal control over financial reporting. In the Section 404 requires the management of public companies to assess the effectiveness of their organization's internal control. This entails providing an annual reporting addressing the following points. First, understand the flow of transactions, including IT aspects, in sufficient detail to identify points at which a misstatement could rise. Second, using a risk-based approach, assess both the design and operating effectiveness of selective internal controls related to material accounts. Third, assess the potential for fraud in the system and evaluate the controls designed to prevent or detect fraud. Fourth, evaluate and conclude on the adequacy of controls over the financial statement reporting process. And lastly, evaluate entity-wide controls that correspond to the components of the COSO framework. So, regarding the control framework, the SEC has made specific reference to COSO as a recommended model. Furthermore, PCAOB on the Auditing Standard Number 5 endorses the use of COSO as the framework for control assessment. So, although other suitable frameworks have been published, any framework used should encompass all of COSO's general themes. Then let's talk about the internal control objectives, principles, and models. An organization's internal control system comprises policy, practices, and procedures employed by the organization to achieve four broad objectives: to safeguard assets of the firm, to ensure the accuracy and reliability of accounting records and information, to promote efficiency in the firm's operations, and to measure compliance with management's prescribed policies and procedures. So we have three modifying principles: the management responsibility, reasonable assurance, and methods of data processing. So who will employ this? So it is the management responsibility to establish and maintain an internal control system. So the internal control system provides reasonable assurance that the four broad objectives of internal control are met in a cost-effective manner. Then it should achieve objective regardless of the data processing method used, which might vary with different types of technology. Then the limitation of internal controls, we have the possibility of error because no systems are perfect. Then the circumvention via collusion, the management override, and the changing conditions. So we have the internal control shield. So the absence or weakness of control is called exposure. So as you can see in the picture, exposure described as hole in the control shield increases the firm's risk to financial loss or injury from undesirable events. So these include attempts and an unauthorized access to the firm's assets, including informations, fraud perpetrated by persons both inside and outside the firms, errors due to employee incompetence, faulty computer programs, and corrupted input data, and the harmful acts such as unauthorized access by computer hackers and threats from computer viruses that destroy programs and databases. So that's all for my report.
Assalamualaikum and good day everyone. My name is Muhammad Najir Abdullah and I was assigned to continue to discuss the remaining topics in this chapter. So Mr. Antap already covered the overview of auditing up to communicating results, and Ms. Haji Omar also finished discussing the audit risk up to internal control objectives, principles, and models. So the remaining topics will be my part to discuss. Let us first begin with the PDC control model. Make it simple, PDC control model is composed of three levels of control: the preventive control, the detective control, and lastly, the corrective control. Let's first discuss the preventive control. To make it simple, preventive control is simply the first line of defense because it is a passive technique in auditing which is designed to reduce the frequency of occurrence of undesirable events such as fraud, mischief, access, and etc. As you can also see in the illustration, yung mga arrow ay yun yung undesirable event. At kung mapapansin ninyo, yung preventive control ay sila yung unang magbablock doon sa mga undesirable event in reaching our asset. The best example of preventive control is the access control, kung saan yung mga authorized personnel lang yung makakapasok or makaka-access sa isang data kasi sila lang yung may keys or may alam ng password. It is a technique to avoid a certain information being hacked or being accessed by the person who is not authorized. Other example is the separation of duties to workers to avoid the work being repeated, which is also may lead to misstatement. Pre-approval of actions and transactions are also good examples of preventive control because it restricted the unauthorized person to act or to do a transactions on his own, which may also lead to undesirable event. The next level of control is what we call the detective control. It is a device, techniques, and procedures designed to identify and expose undesirable events that escape the preventive control. As you can see, hindi totally 100% nabablock ng preventive control lahat ng undesirable event na paparating. So the job of the detective control is to identify and expose yung mga undesirable event na nakalusot sa preventive control. For an instance, dahil may mali sa data entry natin, like what is illustrated here, it is a job of the detective control to recalculate the total value using the price and quantity. Last one is what we call the corrective control. To make it simple, yung corrective control is the one who finds solution and correct the problem that being detected by the detective control. As you can see, yung detective control and corrective control is always yan magkasama. Yung detective control kasi yung nag-identify at nag-expose ng undesirable events. Yung corrective control naman, yung nagsusolve ng problem na na-detect ng detective control. We also need to remember that for any detected undesirable event, there may be more than one feasible corrective actions, but the best course of actions may not always be obvious. Let us use this again as an example. Look at the problem, you may say na yung mali is yung total kasi instead na 1,000, it should be 100. But it may not be the best solution kasi possible na yung mali is yung quantity kasi instead na 10 pieces, maybe it should be 100 pieces. Let us proceed to the next topic, which is the COSO Internal Control Framework. The COSO framework is consists of 5 components: the control environment, the risk assessment, the information and communication, the monitoring, and lastly, the control activities. First is the control environment. It is the foundation of other four control components. Napaka-importante ng control environment dahil naaapektuhan nito yung control awareness ng isang management and employees. I-require din ng SES 109 na kailangan ng isang auditor na maka-obtain ng sufficient knowledge to assess the attitude and awareness of the organizations, management, board of directors, and owners regarding internal control. For an instance, dapat maintindihan ng isang auditor yung mga types of business ng isang kliyente at dapat aware din siya sa mga condition na pwedeng maka-affect sa pag-audit sa isang industry. Auditors should also read the industry-related literature and familiarize themselves with the risks that are inherent in the business. So these are the important elements of control environment: the integrity and ethical values of management, the structure of the organizations, the participations of the organization's board of directors and audit committee, the management's philosophy and operating styles, the procedures for delegating responsibility and authority, the management's method for assessing performance, the external influence, and lastly, the organization's policy and practices for managing its human resources. The next one is the risk assessment. Risk assessment's function is to identify, analyze, and manage risk relevant to financial reporting. Risk can arise or change from circumstances such as changes in the operating environment that impose new or change competitive pressures on the firm, new personnel who have a different or inadequate understanding of internal control, new or re-engineered information system that affect the transaction processing, the significant and rapid growth that strains existing internal controls, the implementation of new technology into the production process or information system that impacts the transaction processing, the introduction of new product lines or activities with which the organization has a little experience, the organizational restructuring resulting in the reduction or reallocation of personnel such that business operations and transaction processing are affected, entering into foreign market that may impact operations, and lastly, adoption of new accounting principle that impacts the preparation of financial statements. The third one is the information and communication. The accounting information system consists of the records and method used to initiate, identify, analyze, classify, and record the organization's transaction and to account for related assets and liabilities. The quality of information that the accounting information system generates impacts the management's ability to take action and make decisions in connection with the organization's operation and to prepare reliable financial statement. An effective accounting information system will identify and record all valid financial transactions, provide timely information about transactions in sufficient detail to permit proper classification and financial reporting, accurately measure the financial values of transactions so their effect can be recorded in financial statement, and lastly, accurate record transactions in the time period in which they occurred. SES 109 required that auditors obtain sufficient knowledge of the organization's information system to understand first the classes of transactions that are material to the financial statement and how those transactions are initiated, the accounting records and accounts that are used in the processing of material transactions, the transactions processing steps involved from the initiation of the transaction to its inclusion in the financial statement, and lastly, the financial reporting process used to prepare financial statement, disclosures, and accounting estimates. Another type of control component is the monitoring. So monitoring is the process by which the quality of internal control design and operation can be assessed because management must determine that internal controls are functioning as intended. This may be accomplished by separate procedures or by ongoing activities. An organization's internal auditors may monitor the entity's activities in separate procedures. They gather evidence of control adequacy by testing controls and then communicate control strengths and weaknesses to management. As part of this process, internal auditors make specific recommendations for improvements of control. Ongoing monitoring may be achieved by integrating special computer modules into the information system that capture key data and permit tests of control to be conducted as part of routine operations. Embedded modules thus allow management and auditors to maintain constant surveillance over the functioning of internal control. And last but not the least is the control activities. Control activities are the policies and procedures used to ensure that appropriate actions are taken to deal with the organization's identified risk. Control activities can be grouped into two distinct categories, the physical controls and the information technology controls. The first category is the physical control. It is simply refers to the human activities employed in the accounting system. These activities may be purely manual, such as the physical custody of assets, or they may be involved the physical use of computers to record transactions or update accounts. Physical control also composed of six categories activities: the transaction authorization, the segregation of duties, the supervisions, the accounting records, the access control, and lastly, the independent verification. The second category naman is the information technology control. The information technology drives the financial reporting processes of modern organizations. Automated systems initiate, authorize, record, and report the effects of financial transaction. As such, they are inseparable elements of financial reporting processes that SOX considers and must be controlled. Also identifies two broad groupings of IT control: the application controls and the general controls. The objectives of application control are to ensure the validity, completeness, and accuracy of financial transactions. Application controls have a direct impact on the integrity of data made their way through various transactions processing systems and into the financial reporting process. The second broad group of controls defined by the COSO framework is the general controls. They are so named because they are not application specific but rather apply to all the system. Although general controls do not control specific transactions, they have an effect on transaction integrity. For example, consider an organization with poor database security controls. In such a situation, even data processed by system with adequate built-in application controls may be at risk. An individual who can bypass database security may then change, steal, or corrupt stored transaction data. Thus, general controls are needed to support the functioning of the application controls, and both are needed to ensure accurate financial reporting. Prior to passage of SOX, external auditors were not required to test internal controls as part of their attest function. They were required to be familiar with the client organization's internal control but had the option of not relying on them and thus not performing tests of controls. Therefore, the audit could and often did consist primarily of substantive tests. SOX legislation dramatically expands the role of external auditors by mandating that they attest to the quality of their clients' organization's internal control. This constitutes the issuance of a separate audit opinion on the internal controls in addition to the opinion on fairness of the financial statements. The standard for this new audit opinion is high. Indeed, the auditor is precluded from issuing an unqualified opinion if only one material weakness in internal control is detected. Interestingly, auditors are permitted to simultaneously render a qualified opinion on internal controls and an unqualified opinion on financial statements. In other words, it is technically possible for the auditors to find internal controls over financial reporting to be weak but conclude through substantive tests that the weakness did not cause the financial statement to be materially misrepresented. For example, consider an organization with poor database security controls. In such a situation, even data processed by system with adequate built-in application controls may be at risk. An individual who can bypass database security may then change, steal, or corrupt stored transaction data. Thus, general controls are needed to support the functioning of the application controls, and both are needed to ensure accurate financial reporting. As part of the new attestation responsibility, PCAOB Standard Number 5 specifically requires the auditors to understand transaction flows, including the control pertaining to how transactions are initiated, authorized, recorded, and reported. This involves first selecting the financial accounts that have material implication for financial reporting. Then auditors need to identify the application controls related to those accounts. As previously noted, the reliability of application controls rests upon the effectiveness of the general controls that support them. The sum of these controls, both application and general, constitutes the relevant IT controls over the financial reporting that the auditors need to review. Thank you for listening and wassalam.